customers as on date. We have 46 clients in the $50 million range, which is again an increase of 3 from the last year. Overall, our $1 million category is now at 939 clients, which is a 57 clients added during the last financial year. These two metrics, the clients growing and the $1 million clients growing, is again very reflective of the large clients growing is reflective of our mining capability, where our propositions are relevant and customers are willing to spend more with us and our services are very relevant. And the $1 million client growth is a lot of good high growth companies or big companies where we have made initial entry and they offer a lot of potential to grow. From a bookings perspective, we booked about $2.08 billion of net new deals in the last quarter. In FY23, our bookings grew 4.3% on ACV and 6.6% on TCV on year-on-year basis. Last quarter, we signed 13 large deals across products and services. Couple of deals I want to highlight is a global top 100 banking and financial services company in our new frontier markets. A new client, he selected HCL Tech to transform its customer relationship channels. HCL Tech will implement a new modern Salesforce CRM and omnichannel solution to enable the bank to deliver hyper-personalization to its customers. This is the largest win for this quarter and a big one as we look beyond our core geographies. It's also a deal during a period when financial services globally is in a state of flux. We won a few other large deals both in US and Europe in this sector, which is a sign of our propositions in this market. A Fortune 500 company, a long-term client, expanded their partnership with HCL Tech to accelerate digital transformation across its operations through convergence of IT, which is information technology, and OT, which is the operations technology. HCL Tech has got a charter to modernize the OT environment to drive automation, enhance the safety of employees and productivity of equipment, leading to a more sustainable operations. Moving on from booking to pipelines, our pipeline continues to remain close to record high and is well distributed across geographies, segments, and service lines. Last 2 years, I think, has been a period of optimization. But as I look at our pipeline, I believe clients know the value of the technology and what it brings to the overall business. Still a little early days, but we do believe the tech spend is so vital for most of our clients, so they will continue to remain invested in their tech projects. In terms of people, Ram will cover some more details, but before I hand it over to Pratik, I want to cover a couple of more points. While there has been some stress and uncertainties in the system, be it booking delays or ramp-up delays, it's largely on the discretionary spend side. A lot of run-the-business spend, we don't see that much of stress. That gives us good confidence, given our strength in both the transformative spend and the operating spend. Amidst all the volatility, I want to call out a particular sector that all are validly concerned about, which is our financial services. We continue to see good opportunities. This quarter, we grew sequentially 6.9% in our financial services business. This is on the back of large deal wins, which we have been able to execute very well. We've transitioned on time, so the ramp-ups have been absolutely on dot to ensure that the large wins are converting into revenue. And also it's on the strength of both cloud and hybrid cloud adoption in the financial services sector, where we have a strong play, and that's what is helping, especially in insurance and capital markets in the financial services industry. Our recent wins in financial services is across all regions, Americas, Europe, and even our Latin American countries where we initiated presence in the last few years. I want to also highlight some accomplishments of HCL Tech in the last quarter on the ESG front. MSCI has rated HCL Tech as an ESG leader in the software and services industry and has upgraded our ESG rating from A to AA. HCL Tech has been included in the S&P Global Sustainability Yearbook 2023 as an industry mover for demonstrating sustainable business practices. We've also been included in Sustainalytics 2023 top-rated ESG companies list in the software and services segment in the Asia-Pac region. Now, coming to FY24 guidance, I believe FY24 will be a year of consolidation, both on the demand side and the supply side, because you've seen a lot of fluctuations in the demand over the last 18 months. Similarly, there has been a lot of fluctuations in the supply side, whether it is hiring, wages, all of that. I think FY24 will be a year of consolidation, and clients have accelerated their technology spend over the last many quarters. Since the beginning of the pandemic, it's time to review and consolidate with the most efficient and impactful technologies, and similarly consolidate with vendors who provide best-in-class services, who have the capability to scale globally, who are nimble, who value the relationship and partnership. It's those service providers who are going to win. Coming to guidance for FY24, we're forecasting a healthy revenue growth in the range of 6 to 8% and operating margins in the 18 to 19% range. With that, I'll request Pratik to give a little more details on our financials.
Thank you, CVK. I'll give you some more highlights, but the biggest highlight is, of course, the 1 lakh crore, right? On a quarterly basis, services revenue came in at 2.9 billion, which is up 0.6% in constant currency. Year on year, as CVK already mentioned, is 10.6. Within that, ITBS, IT and Business Services, came in at 1.6% sequentially, and 11.4 in year on year. ERS was the segment which showed a sequential decline, 3.8%, due to customers cutting back on some of the discretionary spending, leading to some ramp downs and paused delayed programs. But in year-on-year basis, they grew 7.3% in constant currency. Software reported a solid 7.9% in constant currency on a year-on-year basis. And if you exclude the divested business, it was actually at 8.2%. So that's a very healthy growth coming from that business. And therefore, the total revenue for HCL Tech in rupee terms came in at 26,606 crores, which is in rupee terms 17.7%, close to 18% increase year on year. For the quarter, EBITDA margin is 21.9% and EBIT at 18.1%. And net income came in at 14.9%. Which is up 1.3% on a year-on-year basis. We added headcount in the quarter, 3,674, about which Ram will sort of talk about more. Since this is the annual number also, so becomes a little bit of overflow of numbers, but let me quickly cover that off. So the total revenue came in at 101.456 crores, 1,01,456 crores, which is up 18.5% year on year in rupee terms. And even in constant currency, we are up 13.7%. Software delivered a growth of 1.8% in constant currency after excluding the divested business. Services grew at 15.8%, and EBITDA came in for the full year at 22.3%, EBIT at 18.2%, and profit after tax or net income at 14.6%. We continue to generate good cash conversion of the net profits. So last 12 months operating cash flow came in at $2.23 billion, which is 121% of the net income. So we generated 21% more cash flow than the net income. And in free cash flow terms, which is after the capex, it is 110% of net income, which is 2 billion odd. Our balance sheet continues to strengthen. Gross cash is now at $2.8 billion and net cash at 2.5 plus. For the shareholders, we delivered earnings per share of close to 55 rupees, 54.79 to be precise, which is a 10% growth year on year. And the board has declared a dividend of rupees 18 per share for the quarter, which takes our full year dividend at to 48 rupees, because in the first 3 quarters we've declared 10 rupees per quarter each of the 3 quarters. So 48 rupees per share as a percentage of the EPS of 54.79 comes out to be 87.5%. We had promised a minimum of 75%, and we are happy to be beyond that for the second year running over that period of 5 years that we had made the commitment. The record date for the dividend is 28th April, and the payment date shall be 9th of May. With that, I'd like to hand over to Ram for the HR updates.
Thanks, Prateek. A very strong performance across all segments of our business is attributable to our people. Our people strength ended at 225,944. That's a net addition of 3,674 for this quarter. That included 4,480 freshers for this quarter. The total fresher addition for the year is 26,734. That's shy of the 30,000 aspirational number that we were working towards. But the good thing is we honored all the offers that we made, and we onboarded everybody without having to make any delays, and that's baked into our plan. Our plans are a quarterly rolling plan, so it allows us to moderate our intake in line with what the demand is. So we were able to conclude the year pretty much close to what we thought we would be in terms of fresher intake, more importantly, without having to defer or delay any of the onboarding. So that's good. Attrition has been a phenomenal story. We're ending the year with 19.5% attrition. The quarterly trend, last quarter I reported that we saw the attrition peak in the last quarter. If we look at the quarterly trend, last quarter I reported 210 BPS drop quarter on quarter. This quarter at 19.5, it's a 220 BPS drop quarter on quarter. So the quarterly trend on attrition is very encouraging. And I think in summary, the success that we have had in FY23, I think it's clearly attributable to our people strengths, not in just numbers, but also in terms of the skills and the investments that we have made through the year in our upskilling programs has all contributed to where we are today. And also the guidance for the next year is also on the back of what strengths we have built in FY23. So that's, with that, we'll probably open for questions. Yeah.
So on the mic, please identify yourself and your publication. And I'll go first. Saurabh? Uncle?
Hi. Hi. Good to see you all. Good evening. My name is Sankalp. I work for Bloomberg News. I wanted to ask about your revenue mix. I mean, you've added clients in every category in $100 million, $50 million. But if I see the revenue mix, your your business in the US has actually grown only by a few percentage points revenue. Again, in Europe, by just 2 percentage points. Rest of the world has actually declined. Then financial services, again, the revenues declined by a few percentage points. Public services down, retail down, telecom down. The growth in manufacturing is just 1 percentage point. Your commentary is overall positive. So I wanted to ask you, like, despite adding so many clients, the revenue hasn't really grown. The revenue mix I'm talking about. And then the guidance is a bit conservative. So can you give us a sense of where the slowdown is, especially in Europe and the US? And also, I mean, are clients delaying payments for projects? Are any projects stalled? Could you give us some color, please?
Can I just borrow that? Yeah. So if you look at our vertical growth, the quarter-on-quarter growth in financial services is 6.9%, right? And America's quarter-on-quarter growth is 1.8%, and year-on-year growth is 10%. And so I think these are good growth numbers. So I don't know what exactly you're referring to. In terms of the verticals, there are 3 verticals on a quarter-on-quarter basis have declined, but financial services has been strong, life sciences and healthcare has been strong, public services has been more flattish, retail CPG has grown 0.6. But if you take the constant currency year-on-year growth, it looks very, very strong. The tech and telecom are the 2 verticals where we are seeing softness. There are some discretionary spends which are being cut back, and that is really showing up in the decline in revenue in tech, which is sequentially declined 1.6%, but bigger impact in telecom, where you see a 5.6% decline. Now, manufacturing, also there is a decline, but it is primarily due to a one-time impact of a project coming to an end. That's why you'll see a decline of 3.5%. I hope this answers your question.
If I may just add, Sanket, you asked a slightly larger question as well. So look at it this way. All said and done, the growth in ITBS is 1.6% sequentially, right? Now, that is in keeping with the times, okay? And if you talk about the next year, we are guiding 6 to 8%, in services terms 6.5 to 8.5, right? Compared to the 13.7 we delivered this year. So yes, there is a change in the overall environment, which is factored into the numbers that are in front of you. I hope that answers your larger question that you had in your mind.
Hi, good evening. Abhimanyu, this side from CNBC-TV18. I have 2 questions. Firstly, can you explain for BFSI, very strong growth and very weak growth in telcos, and also any project cancellations and deferrals and the outlook on hiring?
So financial services, as I mentioned, is grown on the back of strong ramp-up in the large deals that we won in the previous quarters. So we've had a phenomenal execution. All the execution has been on track. Our ramp-ups have happened on time, and we've transitioned some large clients. We've also had some good programs in our financial services clients around cloud adoption and modernization. That's also contributed to the revenue. And if I just break financial services into banking, capital markets, and insurance, I think both capital markets and insurance is where we had the maximum growth. Telecom, as I called out even last quarter, we see cut in discretionary spend to be a little sharp. That's why you'll see a 5% plus decline. I think most of that has already happened. It's pretty much happened from the beginning of the quarter, or some follow-on impact of the ramp downs that happened in the last quarter. We're cautiously optimistic of what would a further span out in these two segments because there are some clients where there is concerted effort to be more efficient, and then we are getting some work coming our way. And there is other clients where they're a little more choosy about what discretionary projects to invest in. So this is the broad commentary on these two segments.
If we look at the EBIT margin, it has dropped 1.5% quarter-on-quarter basis. So what is is there any pressure from cost side, or what is the reason behind?
No, there is no pressure on cost side. I think the simple way to read, the correct way to read is the year on year. In our software business, we have a seasonality where the December quarter is a peak. So as per the seasonality, when you have a peak, then there is a drop in the next quarter, which happens to be this quarter. That's the only reason. Otherwise, if you look at it, last year, I think we were 17.9, we are at 18.1. I think the overall trajectory remains strong. It is just the seasonality in the software business.